About 55% of Americans live paycheck to paycheck. 36% have more credit card debt than emergency savings, and 22% have no emergency savings at all. Many people lean into credit cards not because they want to, but because they have to. This financial vulnerability is compounded by recent news of major credit companies ceasing lending activities in the United States, further limiting options for those in economic distress. This abrupt change hits vulnerable groups the hardest, making it even more challenging for them to get financial help. It's a reminder that people need to plan ahead and explore other financial options. The major credit card players, including Discover, Visa, American Express, and MasterCard, are currently grappling with a proposal that could reshape their profit landscape. The Consumer Financial Protection Bureau has recommended a substantial reduction in credit card late fees, potentially decreasing the fees from the existing range of $25 to $40 down to a flat $8. This proposal, if approved, would mark a considerable threat to the profits traditionally derived from late fees by these influential credit companies. As the verdict on this proposal awaits approval from the White House, the credit card industry is on edge, recognizing the potential for a significant 75% reduction in profits generated from late fees. The outcome of this decision holds the power to influence the strategies and revenue models of these credit giants, prompting them to closely monitor the situation and adapt accordingly. The proposed reduction in late fees is not a concern exclusive to credit card companies. It also holds implications for consumer behavior. With the possibility of late fees dropping to a mere $8, consumers may perceive less financial pressure to prioritize timely credit card bill payments. This shift in consumer behavior could lead to changes in repayment patterns, introducing uncertainties into the revenue streams that credit card companies traditionally depend on. The financial landscape is undergoing a shift, with rising concerns over delinquencies in credit cards and auto loans. A recent report by Moody Analytics reveals a concerning trend where households are accumulating more debt. In just a 3-month period from July to September, household debt increased by a significant $1.29 trillion, marking a $3.1 trillion surge since the previous quarter. This surge in debt raises alarms about potential economic challenges on the horizon. The report highlights that delinquencies, or instances of borrowers falling behind on their monthly credit card and car loan payments, are on the rise. This trend is not only a cause for worry among individuals managing their debts, but also raises broader concerns about the overall health of the economy. As more Americans struggle to meet their financial obligations, it poses a potential harbinger of economic troubles ahead. These economic challenges are not isolated to borrowers alone. Lenders, including credit card companies and auto loan providers, face a complex scenario. The increased risk associated with rising delinquencies prompts lenders to reevaluate their lending practices. For those grappling with credit card debt, a potential lifeline comes in the form of balance transfer credit cards. These cards, notably those with a 0% interest rate, provide consumers with a means to navigate their debt more effectively. The concept revolves around transferring existing balances to these cards, allowing individuals to sidestep interest payments temporarily. This strategy is particularly appealing as it offers a breathing space for those looking to manage their debt more strategically. By consolidating debt onto a card with no interest for a specified period, individuals can channel more of their payments toward reducing the principal amount owed. This approach can be a game changer for those aiming to become debt-free without the burden of accumulating interest. A recent survey has revealed that nearly half of Americans carrying credit card debt are worried about their ability to repay it. This statistic sheds light on the widespread financial stress experienced by a significant portion of the population. The concerns expressed by these individuals regarding their credit card debt highlight a growing trend of financial anxiety among consumers. MasterCard is stripping the stripe from its credit cards. MasterCard announced plans to remove the black magnetic stripe from all of its credit and debit cards. The stripe will become optional for new cards in 2027, then vanish by 2033. While neither Visa nor American Express has announced any plans to ditch the stripe themselves, there's a variety of reasons why it's probably a matter of time. The magnetic stripe can degrade or even demagnetize over time, forcing the owner to replace the card. It's also not very secure. Industrious thieves have long used tiny skimmers that can be placed inside legitimate payment terminals to harvest your data. Consumers see card choice as a way of improving credit scores. A new report by PIMS found 70% of surveyed consumers think their credit scores are above average, while just 45% have scores over 751, the above-average mark according to national credit reporting data. Researchers also found widespread consumer support for efforts to improve credit scores and creditworthiness, stating 62% of consumers want to raise their scores, including a 41% share who say they are very or extremely interested in doing so, and another 29% who are very or extremely concerned about their credit scores. Revenge spending drives ballooning United States credit card balances. The term revenge spending refers to a phenomenon where consumers, after experiencing periods of financial restraint or economic challenges, engage in increased spending to make up for the constraints they face. In the context of the news about ballooning United States credit card balances, revenge spending appears to be a significant factor contributing to the growth of credit card debt. As consumers emerge from economic downturns or periods of financial uncertainty, they exhibit a pent-up demand for goods and services, leading to a surge in spending. This behavior is driven by a desire to compensate for the constraints experienced during tougher times. In the case of credit card balances, revenge spending is resulting in increased usage of credit cards to fund purchases that were delayed or foregone in the past. Revenge spending is playing a role in the rising levels of consumer debt. As individuals feel more confident about their financial situations, they are more inclined to use credit cards for discretionary spending. This is leading to higher credit card balances, as consumers may carry over outstanding amounts, incurring interest charges and contributing to an overall increase in debt levels. Reasons of credit card debt. Rise in America. One of the most common reasons that people fall behind on their credit card debts is that they just can't stop themselves from buying things that they don't really need and certainly can't afford. Whether we are talking about a late-night shopping spree at your favorite online retailer or cramming a few too many things into your cart at the grocery store, overspending can get out of control in the blink of an eye. American consumers are also finding that increased levels of fixed debts are hampering their ability to keep up with credit card payments. Between student loans, mortgages, and vehicle loans, the average American is carrying more debt than ever today, and that is before we even consider their credit card debt. Mortgage balances saw the highest increase, which is in line with the central banks raising interest rates to cool down the blazing hot housing market. Auto loans also went up, with balances in 2023 increasing by $33 billion. As the cost of everyday items such as clothing, groceries, and home decorations continues to escalate, consumers find themselves spending more money than in the past. Opting to pay for these necessities with credit cards results in the swift accumulation of balances that pose challenges when it comes to repayment. As consumer goods prices soar, wages in various regions have failed to keep pace with the same rate of increase. This disparity is making it increasingly difficult for individuals to align their spending with their earnings, inevitably leading to a path where delinquent credit card debt becomes a prevalent issue. Since many Americans fail to pay off their full credit card balances each month, many are forced to pay incredibly high interest rates that seem to be constantly on the rise. In many cases, the interest charges can be more than the minimum payments, which creates a cycle that drives the consumer deeper and deeper into the hole each month. The average interest rate on credit card debt has soared to nearly 20%, from just over 16% at the beginning of last year. That's the largest one-year increase in the 4 decades. While things like overspending can be fixed with a little bit of discipline, unexpected emergencies can arise out of nowhere to completely ruin even the best financial planners. In many cases, consumers point to these issues as the reasons they fall behind on their credit card payments and fall into delinquent status. In response to these widespread financial struggles, major credit card companies in America have made the decision to stop lending. This move reflects their concerns about the financial well-being of consumers and the potential risks associated with extending further credit. Average number of credit card transactions. In April 2023, the Federal Reserve released the results of the Federal Reserve Payments Study, which examines the non-cash payment habits of American consumers and businesses in recent years. According to the study, The number of credit card payments in the United States increased by nearly 26 billion between the years 2018 and 2023. This increase represents a growth of 6.2% per year. Consumers and businesses used credit cards to make 157 billion payments in America. During that same year, credit cards made up 77% of non-cash payments. How to pay down credit card debt? Credit cards, when managed wisely, offer valuable benefits, but carrying a balance can lead to financial challenges. The key is to consistently pay your bill in full and on time. If you're dealing with credit card debt, there are effective strategies to improve your situation. Approaches like the debt snowball or debt avalanche can help organize your debt elimination plan and potentially boost your credit score. Additionally, debt consolidation, whether through balance transfer credit cards or loans, can expedite payoff and save on interest. To succeed, it's crucial to avoid overspending during your credit card payoff journey. Regularly reviewing your budget and tracking expenses ensures you stay within your means. Comment down below on what you think, and leave a comment if you find value in the content we do on this channel. Hit the subscribe button for all the latest updates, and we'll see you in the next video.